Hey, all, my name is Paul Borosky, and I am the owner of Quality Business Plan. And today we are covering pro forma financial projections. Specifically, we are going to master pro forma financial projections in this series. And today we are covering step 5, which is growth rates for revenues as well as costs in pro forma financial statements. All right, so the way the video is going to play out is first and foremost going to go ahead and give you a little bit of background about me, who I am, what I do, and why I do it. And then after that, we'll dive into mastering pro forma financial statements, specifically growth rates for revenues and cost in your statements. As promised, a little bit about me. Again, Paul Borosky, doctoral candidate, MBA, as well as owner of Quality Business Plan and Quality Business Consultant. I am a professional writer, specifically a business plan writer. So if y'all want to avoid all the fun and excitement, trials and tribulations, growth opportunities of writing your own business plan, feel free to pick up the phone, give me a call, send me a text, send me email. My contact information is right here. I would be delighted to write a business plan for you. I am also a published author on Amazon.com. Check out some of my books there. They're focused on business plan writing as well as understanding financial statements. And then finally, I am an adjunct professor and subject matter expert in both business and finance. So if you do need some help with those pesky financial projections, business plans ready to go, but those numbers are keeping you up at night, I'd be delighted to do your financial projections for you. Again, pick up the phone, give me a call, send me a text, send me an email. Be delighted to help. And enough about me. Let's go ahead and talk about growth rates for your revenues as well as costs. When you're doing your financial statements, you definitely want to use growth rates for both your revenues as well as your costs, because if you don't, then you're going to have just a ho-hum financial model that's going to have your profits and losses that are just going to be the same across the board. For example, if a lender sees $90,000 in salary across the board, well, that tells them immediately, well, you're not growing your executive team, and they're going to start to question your financials. And once they start questioning your financials, the whole world falls apart for the simple fact that your financials, in the whole point of financial projections is we're trying to guess what our revenues are going to be and our costs are going to be for the next 5 years. Everybody knows that you can't do that. They're going to be wrong. But there's a little bit wrong and there's a lot wrong. And when your salary is the same number across the board, or your office expenses are just the same number across the board, that is a lot wrong. That just tells them that you didn't even put any effort into your financial projections to even attempt to guess what your salary is going to be, what your revenues are going to be, what your utilities are going to be for the next 12 months, 24 months, 3 years, 5 years, and so on. So because of that perception, you definitely want to include your revenue. You definitely want to include growth rates for your revenues as well as your expenses. And you don't want them to be the same growth rates because your revenues are going to grow at a different pace as compared to your other costs. So what I'm using for this model right now, I'm using my advanced financial projection model that you can purchase on my website. And I also have a basic model as well. But for this example, I'm using my advanced model. All right, so if you're using my advanced model, or if you're using your own model, that's fine too. But what I do is I'll put all my information on an information page, and then I'll label it the growth rate. So I've got it labeled here, growth rates, and I break it up. I'm going to have my growth rates for my revenues, which are right here, and then I'm going to have my growth rate for my expenses or my cost, and that's going to be down below. Now, typically, when an organization starts up or when they expand after their expansion, their growth is going to be faster as compared to years 3, 4, and 5. From that, I'm going to go ahead and set my growth rates anywhere between 10 to 15 to even 20 to 30% for the first year. And then I'm going to taper it down for the second year. I might cut it in half, and I might go maybe a 7% growth rate. If my growth rate for year 1 is 25%, then I might grow growth rate for year 2 at 15%. But something like that just to show that it's tapering down, because typically when a business starts up, it's going to grow exponentially in the first year or two, and then it's going to start moderating, or it's going to enter its mature phase of the business cycle. And that's why for growth rates for year 3, 4, and 5, I'm going to typically go with 3 to 5% growth rate, or maybe something just a little bit higher than inflation. Maybe go with a 5 to 6% growth rate, depending on what inflation is. And now when I'm going to have my revenues grow at one pace. However, my costs are going to be growing at a different pace. For example, my cost of goods may grow at 1.5%. That's my raw material. If I'm making bicycles, then my cost of goods is going to be me buying the bicycle handles or the pedals or something like that. So my growth rate for the cost of goods is going to be something different as compared to something like utilities. The growth rate for utilities might be a lot lower, or a little bit lower, depending on your industry. But I'm going to break up my growth rates for each one of my costs. For example, I'm going to have a growth rate for cost of goods, growth rate for my salary, my labor, advertising, office expenses, utilities, legal, insurance, and just a catch-all. And the benefit for breaking them up for the different costs is that, let's say you're ramping up for your revenues and you're going to be hiring a lot of outside salespeople. Well, your revenues are going to grow, but your office expenses really aren't going to grow that fast. So that's why you keep those separate. However, your labor expenses might grow a little bit faster, might grow at 10%. Because you're hiring a lot of outside salespeople. So you want your labor to be able to change. If you're taking on an executive team, then you might want to go ahead and change your growth rates for the executive team. But typically, for your office, your utilities, your legal, and your insurance, those you're not going to grow those too much, and you're going to want to keep those at a conservative pace. And now when you tie in your growth rates, so that's setting your growth rates right here. This is just your foundation. This is where you're entering that information. You don't want to hard code this information into your financial statements, because if you want to change your growth rates later on, then you've got to go through your income statement and you got to make those changes all through here. And it can be very time consuming and tedious, and it's going to confuse the bejeebers out of you. So let's go ahead and take a look at how I'm using my growth rates. So for example, let's say our growth rate for growth rate for revenues year one is 25%. So the way that I use that growth rate, I'm going to go to my profit and loss statement, and then I will take that growth rate of 25%, and this right here, this is a reference to the cell on the previous page, which is a growth rate for the revenues, and I'm going to divide that by 12. And dividing that by 12 is going to give me a monthly growth rate. So I'm going to then apply that monthly growth rate right here for month 2. I'm going to apply that to the previous revenues. And I do this right here where I'm multiplying the revenues from month 1 plus, and then I'm multiplying it by the 2.08%. Now, at the end of the day, yeah, we're going to be growing this a little bit faster than 25% because of exponential growth, but it's still, these are projections. Always keep in mind, the financial projection is going to be wrong, and if you're just a little bit wrong, especially with the financial model, you're going to be okay. You're going to be close, and that's what we're trying to accomplish, is to give the reader an understanding of where we think we're going to be, but the projections are going to be wrong, so just keep that in mind. So that's how I'm going to handle the growth rate for the revenues. Now, for the revenue growth rate for the cost, it could be a little bit different. For example, the cost of advertising, I'm growing at 1%. Well, if we look here at my financial model, my advertising is not growing at all throughout the year. I'm maintaining a steady budget for the first year for my advertising. I am not tying in that growth rate until I get to year 2. And you can see where my growth rate is. I'm jumping up to my advertising, jumping up to $1,515 from the previous $1,500. That's where I'm tying in that 1%. I'm taking that 1 plus and the growth rate, and I'm tying that in, and that's where this new number is coming from. All right, so that is how I use my revenue, the growth rates for revenues, and that's how I'm going to use my growth rates for cost when I'm building my financial model. And at the end of the day, once we do that, you're then going to be able to see that my revenues are growing, and it's not at a constant pace. It's staggered to reflect what my vision is going to be for year 1, 2, 3, 4, and 5. And you can see the same thing here where my labor and my advertising and my rent, well, my rent's actually not changing. And the reason that I don't put a growth rate in there for rent is because typically if you are leasing a space, you are going to enter into a long-term contract, and that long-term contract is going to have a set rent for the duration of the lease, and thus I'm not going to have it in there. But you can see how my utilities are growing. You can see how my legal is growing. My insurance rates are growing. And then also my catch-all category as well. All right, so hopefully this information was helpful. So let's go ahead and wrap it up and sum it up. Hopefully this information was helpful in mastering your pro forma financial projections. If you are interested in purchasing the template that I used in this video, you can just go to this link right here. And the template that I used was my advanced financial template version. And again, you can purchase it on this link. If you want a more basic template, I also offer a basic version of the template that I just used for this example. And you can, again, purchase that template right here for the financial model. If you don't want to mess around with templates and you just want somebody to do your financial projections for you, feel free to contact me. Check out my prices page. Love to write you a business plan, of a custom business plan. Love to do your financial projections for you. Completely up to you. Just let me know if I can be of service. And then finally, let's wrap it up with tutorials. If you want some more tutorials on better understanding or mastering your pro forma financial projections, just go to this link right here. All right, hopefully this information was helpful. Go out, make a little bit of money, and have a great day.